A staggering majority of industries are already cutting jobs, which historically has been a clear indicator of impending recessions, warns a leading economist. While the U.S. economy hasn't officially entered a recession yet, the growing number of sectors reducing their workforce is raising serious concerns. Mark Zandi, the chief economist at Moody's Analytics, highlighted in a series of posts on X that the economy is teetering on the edge of a downturn. He reinforced his earlier warnings from the previous weekend, emphasizing that the start of a recession is often only clear in hindsight, as determined by the National Bureau of Economic Research, NBER. The NBER defines a recession as a significant and widespread decline in economic activity lasting more than a few months. Considering various factors, such as personal income, employment, consumer spending, and industrial production. According to Zandi, the most critical indicator is payroll employment data. A consistent decline in employment over several months would strongly suggest a downturn. Although employment figures haven't started falling outright, they have shown minimal growth since May. The latest jobs report revealed that payrolls increased by only 73,000 in the most recent month, significantly below the expected 100,000. Moreover, previous month's data has been revised downward, with May's figure dropping from 144,000 to 19,000 and June's from 147,000 to just 14,000. This means the average monthly gain over the past 3 months is a mere 35,000, a stark contrast to previous trends. Zandi anticipates that further revisions might reveal that employment has already begun to decline. He pointed out that more than half of the approximately 400 industries surveyed are currently cutting jobs, a pattern that has historically signaled a recession. In July, over 53% of industries were reducing their workforce, with only the healthcare sector showing notable job growth. Federal Reserve Governor Lisa Cook echoed similar sentiments, noting that significant data revisions are common during economic turning points. Despite these warnings, the Atlanta Fed's GDP tracker still projects continued growth, with the third quarter forecast increasing to 2.5% from 2.1% last week, although this is a slowdown from the second quarter's 3% growth. Other indicators, such as weekly jobless claims and the unemployment rate, have remained relatively stable, with the unemployment rate fluctuating narrowly between 4% and 4.2% for over a year. However, Zandi cautioned that the jobless rate may not be a reliable indicator of a recession due to the recent decline in the number of foreign-born workers, which has kept the labor force stagnant. He emphasized that a recession is defined by a sustained decline in jobs, lasting at least a few months. While we haven't reached that point yet, the economic policies currently in place are making a turnaround less likely. Wall Street remains divided on the interpretation of the jobs data, with some analysts attributing the slowdown to weak labor demand, while others blame it on reduced labor supply due to immigration policies under the Trump administration. Bank of America argues that the market is confusing a potential recession with stagflation, while UBS warns of weak demand, noting that the average workweek is shorter than pre-pandemic levels. JP Morgan has also raised the alarm, pointing out that private sector hiring has slowed to an average of 52,000 jobs over the past 3 months, with non-health and education sectors showing little to no growth. JP Morgan further notes that the absence of a surge in unwanted separations due to immigration policies suggests that the cooling in labor demand is a strong warning sign of a potential recession. Firms typically continue to hire during temporary economic slowdowns, but when labor demand drops alongside a slowdown, it often signals an impending retrenchment, they explained. As the debate continues, the 2025 Fortune Global 500 list offers a snapshot of the world's largest companies, providing insights into how these economic shifts are affecting global business. Explore this year's list to see which companies are leading the charge in these uncertain times.